Most investors tend to think of income investing as a matter of finding the fattest yield and just harvesting the dividends. But our research suggests that it is consistent dividend growth that really matters when it comes to generating the best total returns from a portfolio of shares, at least if history is any guide. Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this latest edition of our regular markets review, Breaking the Mould, I'm going to look at income investing, but with a twist. So over the past decade, 26 current members of the FTSE 100 have increased their shareholder dividend on all 10 occasions, and three things about this grouping stands out. First, the average share price gain from the 26 firms was 265%. From the start of 2006 to the end of 2015, the FTSE 100 went up by 9% over the same period. Second, the best performers, Paddy Power, Betfair, Arm and Compass, all went up by at least 400%, while the worst three, SSE, Pearson and BAE Systems, still provided capital gains that beat the index hands down, as this graphic here shows, with the top and bottom five. Third, on the 1st of January 2006, the 26 names offered an average dividend yield of 2.8%, based on the dividend ultimately paid for that year. Not a big number. But the 2015 dividend relative to the 2006 share price, now that's an average 9% yield, with next up at 26%. This chart looks at what would have been the 10 highest yields based on 1 January 2006's share price and the actual 2015 dividend. The shares grow into the dividend along with the growth. Now, this isn't as easy as it sounds though, for two reasons. First, not all of those firms were in the FTSE 100 in 2006. DCC, Paddy Power and Betfair and St James's Place have all come through the ranks. Others have been mainstays of the benchmark, including Sky, Diageo and Johnson Matthey, but you may need to do some work on the FTSE 250 as well as the FTSE 100. Second, we all know the past is no guarantee for the future. Pearson has already suggested it may freeze its dividend in 2016 to help rebuild dividend cover, and its shares have been tonked. Other firms where shareholders have suffered when an unbroken run of high dividends has come to an end include Tesco, Sainsbury, Rio Tinto and BHP Billiton. These charts are ugly. This is Pearson and this is Tesco. Both stocks where tough trading finally took its toll on dividend growth plans and hopes. It's therefore very important to check earnings cover for the dividend and make sure a company is not going to have to strain to keep its run going, as diverting cash to fund the distribution and away from investing in the day-to-day business could weaken a company's competitive long-term position. And it's strength here that ultimately provides the pricing power that in turn provides the cash flow that makes the payments possible. Now, this type of investing strategy may not be suitable for your style or personal needs anyway. You're looking at a 10-year horizon of at least 10 years here, and ideally you need to reinvest the dividends rather than take out the cash. So only you can really decide whether it fits your goals or not. If you're in drawdown, for example, you may prefer to take the cash and just focus on high yielders rather than capital growth as well as income. But it may be something for you to research and ponder if income is your goal and you're researching either individual stocks or income funds for yourself. So thank you for watching, and I look forward to seeing you next time.